Hitesh, partner and head tax at KPMG now. There's a digital tax on global technology company which is being proposed. What do you make of the report so far?
This digital tax, India has already enshrined in its domestic tax legislation. It is called the SEP, or Significant Economic Presence, which triggers a business connection in India. Now, significant economic presence has been defined under the Income Tax Act as crossing either a specified number of users in India or a specified amount of value that is derived from India business. If either of these would be triggered, then India would levy a tax on that company which is otherwise a non-resident, but on account of this significant economic presence. However, the point to note is that currently this is only a policy intent, because most of India's tax treaties, including most importantly the one from US, has not been amended to look at significant economic presence. So there is a project going on currently which is called the Inclusive Framework of 130 countries, which is doing the work on the digital taxation and the digital economy. India is part of that framework of 130 countries. They are expected to come out with their report in 2019, and the earliest that we can expect this digital tax to take place in India under the SEP concept will be in 2020.
You know, CBDT is what we understand from reports is that they're seeking to impose 30 to 40% digital tax. Now, talk to us about how reasonable do you think this particular slab is, 30 to 40%, and how much of an impact, if at all, could it have on the companies?
Okay, so let me clarify. 30 to 40% is not a tax number which is pulled out by CBDT out of thin air. It's a derivative of the significant economic presence. So what does our Income Tax Act say? And assuming that the tax treaty is also amended to reflect this significant economic presence tax, it will say that yes, now the company has a taxable presence in India. Thereafter, it is expected that this inclusive framework as well as India will lay down rules how they will determine that once the company has a taxable presence, how much of the gross revenue that they earn from India will actually be subject to tax, because remember, they will also have to give allowance for certain expenditure. Now it's difficult, but they'll have to do that. And thereafter, whatever they determine as the appropriate part of the total income, which can be attributed only to Indian functions, for example, Indian users or Indian sales or Indian marketing. So only let's say a portion of the total income will be subject to tax. Now, where does 30 or 40% come in? Because these are currently the rates at which local companies and foreign companies otherwise pay their tax on business income. So 30%, if let's say a digital company has a presence in India also by way of an Indian subsidiary which now garners revenue here, they will pay at 30% on that appropriate portion after expenditure. Or if that company does not have a, let's say, a physical entity or an Indian subsidiary, then they will pay at 40% of that appropriate portion of the total gross revenue that they will earn from India.